When U.S. President Donald Trump imposed tariffs on steel and aluminum, the decision sparked immediate global backlash, especially from the European Union. Trump's policy, intended to protect American jobs and address trade imbalances, placed a 25% tax on steel imports and 10% on aluminum, igniting fierce debate over its economic rationale and consequences. The European Union swiftly announced countermeasures, imposing retaliatory tariffs on approximately $26 billion worth of U.S. exports. Iconic American brands and products, from Harley-Davidson motorcycles to Kentucky bourbon and Levi's jeans, were specifically targeted, strategically chosen to maximize political pressure. The ripple effects of these U.S. tariffs reached far beyond steel. Industries across the U.S. and Europe felt the immediate impact. While American steel producers experienced a temporary surge, companies relying heavily on steel and aluminum faced increased costs, squeezed profit margins, and potential job losses. Major corporations like Ford and General Motors reported rising production expenses, leading to warnings about potential cutbacks and price increases. Globally, Trump's tariffs reshaped trade dynamics. Asian producers, particularly China, redirected their excess steel to Europe, escalating competition and complicating Europe's existing industrial challenges. The EU's steel sector, already burdened by high energy costs and regulatory pressures, faced further hardship due to cheaper imports from subsidized producers. Economist Trinh Nguyen highlighted how Trump's tariffs amplified global economic tensions, causing other nations to respond defensively. Asian countries like South Korea and Vietnam quickly implemented anti-dumping duties on Chinese steel, indicating that tariffs created a domino effect, triggering protective measures worldwide. For Europe, the situation was particularly complex. Brussels faced the delicate task of protecting its industries while adhering to international trade commitments. With domestic steel production already down by 30 million tons, representing thousands of lost jobs, the EU had little choice but to react decisively. Beyond immediate economic damage, these tariff wars significantly impacted investor confidence and market stability worldwide. Global supply chains, meticulously developed over decades, suffered disruptions, forcing businesses to rethink their strategies, relocate production, or seek alternative suppliers. Looking ahead, the future of global trade hangs in the balance. Continuous tariff escalation risks, further fragmenting markets and weakening international cooperation. Economists suggest a possible way forward through negotiation, advocating comprehensive trade agreements addressing root issues such as unfair subsidies, overcapacity, and ensuring a more level playing field. Ultimately, the tariffs enacted by the U.S. and the EU's response illustrate a broader challenge: the balance between protectionism and free trade. While tariffs offer short-term relief for specific industries, their long-term repercussions often prove detrimental, stunting economic growth, increasing consumer costs, and fostering global economic uncertainty. As global markets navigate these turbulent waters, the urgency for collaborative solutions becomes clear. Whether through negotiated settlements or revised trade policies, finding a path forward that benefits all involved parties remains essential for maintaining global economic stability and growth.